Hello everyone, welcome back to Fundrise Finance. The best part about dividend investing is that you get paid dividends constantly by the companies, no matter the company's stock price is up or down, whether you are in a bull market or a bear market. All that matters is you hold on to the shares. But one thing everyone should take care is the valuation of the company. If you get to buy the stock of a company at a lower valuation, there's a very high chance you'll get to see much better appreciation in the company's stock price. In today's video, I have 5 companies who have recently announced their dividend raises, and we'll see which of these companies are overvalued or undervalued at the moment. Let's check it out. First on our list is General Mills, ticker symbol GIS. General Mills is from the consumer staple sector that manufactures and markets branded consumer foods worldwide and owns many famous brands such as Annie's, Betty Crocker, Cascadian Farm, Cheerios, Chex Cereal, Green Giant, Haagen-Dazs, Lucky Charms, Nature Valley, Pillsbury, and Yoplait. General Mills has a market cap of $45.39 billion and currently yields 2.85% at a forward PE of 18.98. Year-to-date, General Mills has done really well compared to the broader market, returning 12.68%. In the last 1 year, it has given almost 26%. The last 5 years, just over 38% return. From a dividends point of view, General Mills had recently announced a 6% dividend increase. It has been raising its dividends for the last 2 years at a very low 5-year dividend growth rate of 1.22% and a payout ratio of 51.78%. General Mills has ex-dividend date coming really soon on the July 7th. So if you do make a purchase in this company stock before this date, the dividends will be paid out on August 1st at 54 cents per share. Track your dividends gives General Mills a dividend score of 35 and considers it overvalued by 12.97% with a fair value estimate of $65.96. Morningstar considers General Mills a two-star stock with a fair value of $70. But as per my calculations, which considers current and historical yields, I found General Mills to be overvalued by 16.8% with a fair value of $63.06. So with such high valuations currently, so with such high valuations at the moment, I would stay away from General Mills. The next stock on our list is WP Carey, ticker symbol WPC. WP Carey is from the real estate sector. It's a real estate investment trust that manages industrial, warehouse, office, retail, and self-storage properties. WP Carey has a market cap of $16.08 billion and currently yields 5.08%. Year-to-date, WP Carey has returned 2.6%. In the last 1 year, it has returned 11.61%. The last 5 years, the returns have been 25.48%. From a dividends point of view, WP Carey had recently announced a dividend raise of 0.2%. Before you freak out why the dividend increase is so low, WP Carey increases its dividends every quarter by almost 0.2% on average. So we can say for the whole year considered, the dividends cumulatively come up to be around 1 to 1.5%, which we can see in the 5-year dividend growth rate of 1.24%. WP Carey has been raising its dividends for the last 11 years, and the payout ratio is very, very high, more than 150%. Track your dividends gives WP Carey a dividend score of 41 and considers it overvalued by 11.89% with a fair value estimate of $73.46. Morningstar considers WP Carey a 3-star stock with a fair value of $84.43.
But as per my calculations, I found WP Carry to be overvalued by 4.62% with a fair value of $79.52.
I do own WP Carey in my portfolio, and my purchase price has been in the mid 70s. So, yes, I do sit on a little profit over here, but I don't plan to add any more at current valuations. Third on our list, we have Kroger, ticker symbol KR, from the consumer staple sector. Kroger has a market cap of $34.45 billion and currently yields 2.16% with a forward PE of 12.33. Year-to-date, Kroger has been doing good compared to the broader market, returning 6.53%. The last 1 year, it has returned 26.25%. In the last 5 years, a very good 107.23%. From dividend standpoint, Kroger recently announced a monster dividend raise of 24%. That is huge for a consumer staples company. It has been raising its dividends for the last 16 years at a 5-year growth rate of 11.84% with a payout ratio of a very good 21.32%. Track your dividends gives Kroger a dividend score of 48 and considers it overvalued by 20.88% with a fair value estimate of $38.09. Morningstar considers Kroger a 3-star stock with a fair value of $47.50. But as per my calculations, I found Kroger to be undervalued by almost 4%. with a fair value of $50.05. I do own Kroger in my portfolio, where my purchase price has been in the low 40s. So yes, I do sit on a little profit over here. But with Kroger just being undervalued by 4% here, I don't plan to add any more right this moment. If there's any more further price correction in the stock in the near future, I'll do look to add more. Fourth on our list is Diamondback Energy, ticker symbol FANG. I always have a chuckle when I read the ticker symbol for this company because FANG is mostly associated with the technology sector and surely not the energy sector. Diamondback Energy is an independent oil and natural gas company. It has a market cap of $21.28 billion and currently yields 2.31% at a very low forward PE of 4.76. Year to date, Diamondback has returned 10.37%. So just like the energy sector has been doing really good year to date, Diamondback Energy has been another energy company which has done really good so far in this year. The last 1 year, it has returned almost 24%. In the last 5 years, almost 40% returns. From a dividend standpoint, Diamondback Energy had recently announced a 7% dividend raise. It has been raising its dividends just for the last 3 years, and it does not have a 5 year growth rate. That's because Diamondback Energy has started paying dividends just from 2018 onwards, so it is not yet into that 5 year territory. It has a payout ratio of 32.46%. Tracker dividends gives Diamondback Energy a very low dividend score of 20 and considers it undervalued by 47.93% with a fair value estimate of $232.79. Morningstar considers Diamondback Energy a 3-star stock with a fair value of $124. But as for my calculations, I found Diamondback Energy to be undervalued by 15% with a fair value of $139.40. And the last stock on our list is Darden Restaurants, ticker symbol DRI. Darden Restaurants is from the consumer discretionary sector and actually owns chains such as Olive Garden and Longhorn Steakhouse. It has a market cap of $14.26 billion and currently yields 3.85% with a forward PE of 14.77. Year-to-date, Darden has taken a real beating, down more than 23%. In the last 1 year, it is down almost 23%. From dividends perspective, Darden Restaurant recently announced a 10% dividend raise and also a $1 billion stock buyback. Darden has been raising its dividends just for the last 1 year. The 5 year growth rate is 14.46%, and the payout ratio is tad higher at 59.15%. Darden has its ex dividend coming really soon on the July 7th. So if you do own shares by that date, the payout date would be August 1st for $1.21 per share. Tracker Dividends gives Darden Restaurants a dividend score of 56 and considers it undervalued by 27.42% with a fair value estimate of $157.55. Morningstar considers Darden Restaurants a 3-star stock with a fair value of $134. As for my calculations, I found Darden to be undervalued by 29.77% with a fair value of $148.39. So these are the 5 stocks which we just discussed: General Mills, WP Carey, Kroger, Diamondback Energy, and Darden Restaurants. So as we can see here, General Mills and WP Carey are currently overvalued, while Kroger, Diamondback Energy, and Darden Restaurants are undervalued. That's all I have in this video. Hope you all liked it. I would really appreciate if you could hit that like and subscribe buttons and hit that bell notification so that you are informed of all such informative videos that I'll post in the future. And until we meet in our next video, let's do as much as possible to be financially healthy. See ya. Bye.